Good morning, beautiful people of the internet, and we are looking like absolute wankers with our glasses on, but we're very happy people. This is a good sign. So this is the Sunday supplement, our special kind of review of the week that we've been doing on and off, or probably more consistently during COVID. So you're more than welcome to join us. The feed is streamed live onto Piotr Rizanek's Facebook page. It goes onto his LinkedIn. And finally, we share it onto the Property Sisters UK YouTube, which is a brilliant listen at the best of times because I think all of us have spoken on there. So that's always a good reason to go and listen.
And drop us a comment where you're listening from, because that's always interesting to know.
Oh, yeah, do. Yeah.
But as always, and if you haven't joined us before, we start with Adam Lawrence's review of the week, which is some form of treatise on economy and practicality, and this one was a big one. This one, it didn't take long to get through. It was gripping. It kind of felt like it was going to end with London's burning, but it's you kind of you rescued it towards the end. Let's go through it. What's your cliff notes? So taking it from 20,000 words down to about 5,000 words.
Yeah, I'm not that good at the concise bit, as you well know, Joe. But we had enough London's burning with the Bank of England minutes for the meeting this week, because it was a full-on, completely bearish, recession guaranteed, at least a year and a bit long. Average recession usually is 5 quarters, actually, so that wouldn't be out of kilter. And I think what's unusual is that they're calling it now and seeing it coming, whereas there's normally a fairly surprising trigger, not always out of nowhere. You know, we talk about The Big Short a fair bit. There was a fair few people who saw 2008 coming, and it was in the making for 3+ years for some of the people involved in the film, who are featured in the film, Dr. Michael Burry and people like that. Interestingly, Michael Burry's pretty active at the moment on Twitter, if anybody wants to see what he's talking about. But of course, he's generally focused on the US market, so it's not altogether that helpful. But rates went up half. All the press, some nice clickbaity headlines, biggest rise for 27 years, world going to hell in a handcart, etc., etc. People aren't really sure whether to blame the Bank of England, whether to blame. Not much point blaming the Prime Minister at the moment, because obviously he's changing over. But we could blame lots of different things. Although we all know that energy and Vladimir Putin would probably be the top person to blame. But now we've got to the stage where we always knew that we would, in that ultimately energy has started to push everything else up, and once it starts, it's very difficult to break the cycle. So we've seen some pretty rubbish policies suggested by Liz Truss this week about paying public sector workers who've taken it in the face for the last 15 years, even less if possible. But of course, what we're seeing at the moment is whistles to the Conservative Party rather than the 68 million or whatever population we're up to these days of the whole of the UK. But really, the point of today was to say, okay, talking about it myself for quite a while, there is going to be a recession. What do we do in a recession? How do we trade through it?
You might be holding your finger over the mic.
Thanks, Piotr. So how do we trade through the recession? What do we do? Strengthening balance sheets, leveling out gearing, something we've been talking about for some time. Yeah. We've lost the low rates now. They are RIP. So hopefully some of our listeners have got a few loans in the system, which is taking longer than I can ever remember to actually do anything. But those rates are now, I think I saw a 4.18 5-year fix this week, and that was only available if you had an EPC of C or above. So, we're heading towards 4.5%, 5% mortgage rates, and we would be in trouble if it wasn't for the fact that rents are going through the roof. The positives from the eulogy that was the Bank of England meeting minutes, wages are still expected to go up another 6% next year. Now, other than availability of credit, which, as everybody knows, the affordability test has been scrapped. We don't expect a major effect, but it still expands credit rather than contracting it, which is what's needed at this sort of time. And if we have wages going up another 6%, we have more money in pocket ultimately. And then let's see what tax cuts we do get when what looks like one of the better bets of modern times, Liz Truss, does get in, unless she takes her insulting members of the SNP or whatever to a new level. She looks an absolute banker at the moment. So it's really, what do you do in a recession? How do you react to it? Because, you know, I probably haven't made this point enough of banging on about inflation and all the rest of it, but is it a bad thing or a good thing for the people who are listening to this call? Inevitably, it's probably very, very likely to be a good thing. Very, very likely. And anything that the market, the other thing that I mentioned is the market, the brakes maybe seem to be on. Things have flattened out a little bit. We had either a 0.1% rise last month or a 0.1% fall, depending on which one of the ones of the indices you believe. And I think most of the commentary is heading towards the market flattening out a bit. But I don't think we're still. I'm not sure we're past red hot yet. We may not quite have cooled. We may be going into what's one below red hot before we get to a buyer's market. You'd be better to tell me, Jay. To be honest.
Yeah, I think we're still very much in the highs. Yeah, we've managed to get a couple of deals done fairly recently for ourselves, and we got something bought for a couple of guys that are in the buyers club, which was a really interesting story, and that seems to be going well. So it seems like there's opportunity. There's more opportunity, because I think a lot of people get scared away from the market when they hear these rates coming out, because everyone, you know, especially you look at single let resi, if the rates start going up to like 3.5%, 4%, 5% or whatever it may be, that's it. That your mortgage will take that, right? So most single let resi is, you know, by the time you net it again, you know, after tax and all that kind of stuff, you know, most resi's lucky to get away, you know, with 3.5%, 4.5% a year. So I think it's forcing people to really pay attention to their purchase price, because before you haven't really had to worry too much about it, especially if you're playing that long game, because you know after 20 years it'll wash its own face for the most part. But a lot of people are worried about the funding.
Yeah, and in your supplement you said about fall through rates, and probably that was related to like private treaty transactions. But actually the deal we picked up for a client, that was something that sold in the auction for 410, and the person didn't complete, and the person selling had to sell like within 5 days. So we picked it up for a client for 350, and that's like a fall through from an auction. But it happens as well, because people expect to get mortgages sometimes in auctions, and now it's even more difficult than ever.
Yeah, I've got an interesting one about one we sold at an auction the other day, where it was standard 20 working days, tenant in situ, day 15, request from the purchaser, we need to get access for evaluation. Like, for a mortgage. And I was like, no you don't, that's ridiculous. You either got to do this cash or you got to do it on a bridging loan, otherwise you're losing the transaction. It's as simple as that. And they did manage to get it done, and they did get it done on the day. In the end, I doubt that was a bridge, because ultimately I think it shows that people are still getting into the market. And do you know what? They got it on paper. What they bought was cheap. We just didn't want to hold it anymore, because it's at the end of a street and next door to an abandoned, disused warehouse. You know, and it's in a poor part of South Wales. It's done us a solid. It's thrown off a bit of cash. We bought it cheap. It's time to crystallise the paper gain. You know, but there's still clearly inexperienced buyers out there for that sort of stuff. And when you can, because we were saying, look, we're just going to put it straight back into auction. If you don't complete by the end of the notice period, we'll go straight into notice. And we didn't need to in the end, happily, but we just wanted it to be sold.
Leading on from this tangent quite nicely is this month's article that we've written for Property Investor News magazine is exactly what happens for a buyer if you fail to complete an auction. So it's
Good article.
yeah, it's a good article, that bit. Yeah, your bit's all right as well. So we've got this whole thing where for the Property Investor News magazine, we kind of like split the article in two. Normally, I do like an auction market update, just saying that these are the regions that are performing well. This is the asset class performing well. These are the ones that are falling behind. I didn't do that this month, so I might do a Facebook post or a LinkedIn post about it, because 80% of the metrics that EI Group measures, or that they measure more, that they publish as part of their newsletter, is all red, which means it's all decline. And there's very few that are kind of on the green, and they're on the green for now, but not this time last year. So you can see that actually there's no real progress in that part of the market.
Interesting. So what's going to go first then, guys? Commercial or resi, on the back of the recessionary environment through auction?
The problem with that is commercial for the last probably 24 months has been all gain. It's all been up across the board, across the country. It's been performing really very strongly. So if you were to take a metric from 6 months ago and measure it in 6 months' time, so for the year on year, I imagine it would still be green. And if it was red, it wouldn't be as red as it should have been 2 years prior. So if you're looking at mid 2023, and then you've got your comparable numbers 2022, if you then went to 2021, the 2023 figures would be massively up. So it's a really interesting set of figures that they put out, and I see a lot of people sticking with commercial, because commercial, you get, if it's mixed use, you get the blended income from the commercial and the resi. The other thing that you have is when you net down your commercial figure, it's like you might as well just knock 0.5% off of it, right? It's a very easily netted figure. And commercial at the moment, with the Class E's being able to, if this shop leaves, you don't have to get planning permission to put from an estate agent to a chip shop or whatever. There's a lot of things that you can.
Two of my favourite shops, actually, as it goes. Yeah.
Yeah. But it's, I think it's a strong asset class, and I think a lot of people, I think the asset classes that are strong in auction at the moment, because conversations we have with people, is that a lot of people that are looking at resi are looking at resi either for social housing or for service accommodation. Now, service accommodation, you still get the mortgage relief, right? Because so a lot of people are looking at that because they've got that debt and they want to offset that debt a little bit. So.
But you could argue both of those are commercial uses of residential property ultimately.
Yeah, exactly.
And I think you're right. And I think what I've seen over the past week or two has been, I've got concerns over the yields, because as the risk-free rate of return goes up, thanks to the Bank of England and everything, then yields are bound to expand. There has to be a premium. And when it's a risky time like this in recession, there's normally a bigger premium. So the yield compression that we've seen since the rates have been on the floor in 2021 has got to reverse to an extent. But what I'm seeing in the resi rates market is, there's people already hitting sort of 5-ish, Aldermore, Shawbrook, that's where their rates are going. Whereas the commercial at 6, or even I've seen some 5.5 this week, it looks a better proposition, because, as you say, Jay, once you've netted off your cost, that doesn't look too expensive if you're happy that you're letting to comparatively recession-proof businesses. So that at the moment looks more attractive to me, and easier to buy. Well, that's a broad statement, really, but resi's been difficult to buy really well for the last 2 years, obviously. So the commercial market has been a bit more functional. A bit more normal, but as you say, hasn't taken the pain that you would have expected a 2020 to wreak on it. But then all the government money has given people chance to pivot, collect their thoughts. You see loads of stuff opening that has had big capex. So the example that I'm thinking of particularly, an old Debenhams or something, 350,000 square foot. It'll work as a leisure site, no problem. You've got footfall. You've got parking, you've got all of those things, but you turn it into a go-kart track and a bowling alley and whatever else you can fit in 350,000 square foot, it takes some pretty hefty pound notes, but the money's still out there willing to invest in that sort of stuff and take the money back over the next 15, 20 plus years, So I think COVID, in a way, when it hit that pause button for people, it was the same for businesses, and it gave them that chance to do something with that they wouldn't have done otherwise.
Yeah, and I think what COVID did is it forced the focus away from certain types of commercial assets. So I think if a recession was to hit, which it in all likely definitely is going to be hitting, and the same thing with COVID is one of the things that did really well in COVID were like dark kitchens, final mile delivery, warehousing. Because if people aren't going to be going out or they're wanting to reduce their spend, they're going to want things brought to them instead of paying for the petrol and doing all that other kind of stuff. So there's utility out there, and I still quite like the high street. There's some things that I think in this country you can't do bad with, like a fish and chip shop.
Yeah.
Love a fish and chip shop.
Yeah.
They can
Agreed.
make their entire quarter's rent in a weekend. On a Friday, Saturday night, that it's a very profitable cash business. Same thing with a good curry house. Like some of these things that are very difficult to mortgage, fire risk and all that kind of crap. But you have all of that, and there is so much potential for more things to come onto the high street.
Yeah, so I see this. I see this as some of the sort of the cash flow protection stuff that I was talking about today. And the way I sort of frame it these days is, look, there's a yield that you're going to be valued on the basis of. Yeah, you know roughly what it is. There may be an argument over 1% here or there, and that can be really significant. That can be a difference in 20% of the value quite easily. But there'll be an element of opinion. But you pretty much know where you're at on that front. But also what you should do is you should look at what it's worth to you. So we have our own in-house yield on commercial stuff we're looking at getting involved in. And so for example, I'm a big fan of barbershops. I'm a big fan of cafes. I have been for the last 10 years. And now the market's sort of caught up a bit with the internet. I was always keen on the internet proof nature of those businesses. And so you just need to make sure you've got, tenants motivated who can run a relatively simple business, realistically. And, it's actually gone very positively for barbershops because people are more, thanks to Instagram, aesthetics are more important. And, the amount of guys now I know who go weekly to the barbers. I mean, I'm tight, so I go once every month or once every 6 weeks or whatever, and that's in the summer when your hair grows faster and you think, well, I mean, it's an extra 10 quid out of the budget or whatever. I mean, it's terrible. But my friends of mine who go and they go to Tony and Guy or whatever, and I just absolutely blaze them for spending 68 quid on their hair or whatever. It's just nuts. Yeah. We've had a message from the other side. Goodness me, who did we upset?
Angel Barber.
But yeah, I think that's there's some really good protection available in some of these, as Jay said, high street style. They're saying, well, there's stuff getting valued at 12%, and you think, well, do you know what? I don't mind, but if I can buy that, at 11%, I'm quite happy.
Yeah.
The payback period's fantastic, and it's robust. And if the tenant changes over, you can no problem tenanting it, no problem at all. Just got to be quite proactive and accept that at the lower end, you're not going to get a 20-year no breaks FRI lease. Ultimately, there is still some hands-on management to be done, but less hands-on management than a resi property. So it does make quite a bit of sense. The recession-proof nature of it, I think you've got to have a bit of a think about. But yeah, I think there's still some really good stuff out there at the moment. And then if you can convert the uppers or whatever, you've got a double bubble, haven't you?
Yeah. So the last week we bought something in an auction, which is like an industrial unit, and we bought this at 3 industrial units next to each other in Bristol. And we bought this at 10% yield, which is like probably just under what it's worth. But most importantly, like the rents haven't been raised for quite some time, and all those units, they're like 200 square meter units. and they let at like £8,000 per annum, which seems like nothing. Seems like this
Wow.
could be almost
Sounds a bit cheap for Bristol. Sounds a bit more like it should be somewhere up in the northeast at that money.
Exactly. That was what I was thinking as well. So, and Ed found it. We kind of did this as a joint venture with them, and plan is to increase the rents. And also, I think the opportunity of commercial asset is that, like especially with ones like that, you can split the units, and maybe even the owners of the businesses might be interested in buying the individual units, because using the SASs, or like they just being a bit educated how they can structure it so that it works for them, it's tax efficient and all this kind of stuff. So they just need to be put on that path. So
Brilliant. Sounds like a
hope-
fantastic deal.
yeah. And the best thing is we bought for 252,500.
Yeah.
So stamp duty on that is something like £2,000.
Yeah, yeah.
Insane.
But the real story is, we looked at this on the Auction Buyers Club call, and we were talking about it, and Ed was like, I'm looking at this, it looks good. We're thinking maybe £310,000. That's where we started. Then we went through the pack, and a couple of things came back, and then we put in an offer at 280. We said, look, just hold this to order, don't implement anything. Just here's the deposit for that. We were waiting for the asbestos and the 1991 transfer, or whatever it was. There's another document there detailing rights of way and things like that. So all of that came back, and we're like, look, we're here at 250, and they came back and said, well, we'll do the deal at 260. And I said, well, let's just meet them in the middle. And Piotr, no, fuck them. Let's do it at 252,500.
Never split the difference. Absolutely.
Never split the difference.
Beautiful.
Never split the difference. And then they came back and said, yeah, 20 minutes later we're exchanged.
So with the 2.5 grand you saved, you went out last night and blew it all, did you? On White Women in Song.
I feel like we saved 27 and a half.
True.
But,
I think 57,500 we saved, because we were at 310 at one point.
I thought it worked, because if we increase the rent to like 35,000, I think we can sell it for 400. And I don't think it's that much effort.
Right.
And also the whole estate, it's like an industrial estate, and we've got 3 units at the back of it. But the whole industrial estate is so busy, like there's no empty units, and our units are let at £5 per square foot, and they could be let
Between 9 and 11.
Yeah. So it seems like, and there was like, it seemed like there was no competition. Like whenever we got on the call with the auctioneer, it all gave us signs that there's no one else wanting it.
Yeah.
I'm going to call the August effect here. Oh, it's just a beautiful thing when it works.
This is the second consecutive 4th of August that we bought the property, on the 4th of August.
Yeah, well, it's like every anniversary of the 4th of August we buy another property. But the last one was good. This one, hopefully, this one's the same. It's when I get back to the UK, I'll be meeting Ed.
Property Independence Day. Property Independence Day.
Love that.
Yeah, but it's I guess buying commercial property is also like, it's a bit like with residential. You need to know who you're gonna sell to, or who will be buying your asset, and what they'll be able to pay, and how they'll be able to finance it. And I think because people have the SASs and SIPs available, I think with commercial property that market is bigger, and even if they can't get finance, there's still money available to buy those things.
Yeah, I think that's a good point. I think there was a post, I can't remember where I saw it this week, but it was about people talking about, people who've moved things into a SAS, and then they haven't deployed the fund, so it's sitting in cash. So several £1,000s or £10,000 or whatever to get it all set up, and then it's sitting, not invested, depreciating for inflation in the SAS. And there's loads. I think there's plenty of that out there.
Wow.
And obviously the SIP can hold it anyway if people are savvy. You don't need a SAS to do it. So, yeah. Sounds like a great, as I would expect, entry and exit strategy, gentlemen.
Yes, indeed. No, it should be a good deal. Well, it's the first one that we're doing with Ed, and Ed's quite excited. So it's
first commercial for Ed as well. So.
Yeah.
Beautiful.
Awesome.
Yes. What else?
Well, we were going to potentially talk a little bit about we've been playing around with the website, and we're overhauling the Partners in Property digital products overall. We've got a fantastic person working on it with us, but she's been forcing me into doing things like writing blogs and stuff like that. And she's like, "Oh, you need to put the supplement on a blog, and you need to do this, you need to do that." And I was like, "This just sounds like even more work than it normally is, you know." But I'm sure I'm sure I'll get used to it. But one of the things that she was telling me about was putting links to other sites and other interesting things in there. So I kicked off with a Jordan Peterson post that was about what you need to do, how much steel I suppose you have to have in you, and I did like the last bit about the warrior and the garden. So the point was better to be a warrior in a garden than a gardener in a war. And it did make me think of that again this week when we're looking at this nearly inevitable recession. I mean, I suppose there is a potential way out if Truss can pull it together in time, in that she wants to take a huge amount of extra debt out. If she used that to paper over the cracks of the energy prices over the winter, which isn't really her style, and she said no more handouts and all the rest of it. So I don't see how she would reconcile those things. But if she did, arguably, I suppose she could have a snap election in the spring next year and try and win another 5 years, while Labour still look relatively unexciting. If they wait the period that they're going to need to, and the Bank of England are right about 2023, it's going to be hella difficult to win an election in 2024. But we'll see quite quick. I think the beginning of September is going to be very interesting, because we're going to be seeing figures about how much are pensions benefits and housing benefit and things like that going to go up next year. How much is the minimum wage going to go up? What's going to happen to all of that? It's going to be really interesting. And of course, we'll be in the thick of, industrial action that's continuing throughout the holidays. But frankly, I don't know if anybody's got a website like how many strikes in the UK.com or whatever, but that'd be some job just monitoring all the stuff that's going on at the moment. I mean, I missed a couple. There's like with BT, EE, Openreach went on strike. Didn't seem to get any public. I didn't see anything about it.
No, there was an announcement.
Yeah,
there was like a 10-15 minute segment on LBC, but no, I saw nothing in the papers, nothing like that.
No. So I think most people are like, is the phone still going to work? Yeah, okay. Good luck, guys. All the best. All the best. Why do you guys get paid again? Yeah.
Well, the Minister for Transport came out. It must have been 2 or 3 weeks ago. Again, probably on LBC. I was listening to it, where he came out and he said, "Oh, for the 2 years that I've been in this role, blah, not a day has gone by where there hasn't been a strike or the threat of a strike." So that just and that tells you, right, how far people are being pushed, right? Because and the other thing was, who was talking about a social disobedience and things like that. There was someone saying that if things get any worse, there is a line that crosses. I mean, if we were France, we'd be in a revolution 6 months ago. So the English,
the gilets would be out left, right, and centre.
But it won't take much, But for when people realise that they're 2 or 3 meals away from not having 2 or 3 meals in a row, all of a sudden psychology switches and changes massively.
I thought that was really interesting in the supplement this week, where you were talking about, like, obviously I like the cynical bits, but the talk about the energy prices and the expected raises, obviously. But Ruth put something actually on Insta this week about the profits of the energy companies, and I'm like, hang on, like, there's only one person, one side of this equation suffering here. It was, and I know, like, it's not like down with profits and down with capitalism and everything. You've got to remember, lots of people's pensions are tied up in that, so it's not quite as simple an equation as we think in the holistic sense. But it was like, to stomach more increases when there's profits like that was like, really, guys?
Well, yeah, and it looks like the direction of travel, as if and when Truss gets in, is going to be to scrap the, I can't even remember the acronym because it was so stupid, but the temporary targeted energy profits levy or whatever it was called.
Yeah.
Whereas a smart thing to do would be to do the levy and force some investment in renewables, because it would improve the energy strategy. You give them a tax break if they invested in renewables. I don't see what a problem would be with that, for example. But what do we know? What do we know? I'm not a huge, like you guys. I'm more of a fan of letting the market sort things out, and to an extent, it is what it is, and offering up some kind of level of support. So it'll be interesting to see how they square the circle, and what happens with the red wall and all the rest of it, because there'll be many fairly safe Conservative seats that will have more than a little bit of unrest, and I don't know if there's a better idea come out yet than these heat banks they're talking about having, local authority buildings that are heated well over the winter, so people can go down there and not have to have their heating on all day if they're on very limited fixed incomes or whatever. Bit of a sad state of affairs. I think one of the things that could be done that's really not being done is a bit of education for people on what you can save your money on and what you can't. And like, for example, space heating versus, we forget central heating, compared to Victorian times, for example, it's a humongous luxury. And if you haven't got, wouldn't it be nice to see, free upgrades to TRVs if people haven't got them, if they're on low incomes and all this sort of stuff. And you just think, I don't know that anybody's actually doing anything at the moment at this level, because they're so gripped by leadership contests and sound bites and all this sort of stuff that you just think, I don't see and I'm not, they say Liz is a bit of a cut and paste politician. She's got called out a couple of times this week for not checking the facts before she's published a couple of things, and she's had to row back on one of her policies this week already. It'd be nice if we had someone who did like a little bit of detail sometimes, and wanted to actually try and solve some of these problems rather than just kicking them around like a football. But there we go.
There we go. We've got quite a few comments dropping in. James is asking, someone who needs 2 mortgages next weeks, to what extent will the interest rates will already be banked into the new bill? Too scared to ring my broker and ask for a New Year fixed.
I think the thing, James, that I hadn't seen coming was also the service level drop is so dramatic that a lot of lenders that are in the market at the moment are only in at 4.5% and above, and that's not really a fair price for today's 5-year bond yields. It's a fair price for the bond yields 6 weeks ago, but they've calmed down massively. So just to sort of expand on that a little bit, basically what the market's saying is the Bank of England were very forceful in the language that they used. They'll do whatever it takes to control inflation, etc., etc. So people think, well, look, by the time we get to 5 years down the track, base rate will be around about 2 to 2.25. That's the narrative that the markets are delivering, and it could indeed be lower than that, and we may have to lower it quite a bit if we have a deep recession. But the direct answer to the question is pretty much baked in the current viewpoints. And if you talk to the BDMs at the lenders, they're saying rates are still going up, not down, over the next few weeks. So I wouldn't hesitate to pick up the phone, mate, because I'd start getting some of those rates secured. It's pretty ugly at the moment. If you haven't got EPCs of C, you're looking at 4.3 and above. That's where you're at last time I checked, which was Friday, I think. So yeah, I don't think anything's changed since Friday, but deals literally get pulled every day at the moment. Yeah. So that's not me being flippant. It could be different on Monday. And it depends what you're looking for. If it's an HMO and you need a particular lender who will give a commercial valuation on a 6-bed or whatever, you're at their mercy and you're looking at 5. And this is what we're brutally doing, looking at stuff and thinking, well, the flip side of what Jay was saying earlier, if you're at 4.5, 5 on resi, well, and then let's face it, you've also had massive capital growth in the last couple of years. Well, selling it is extremely attractive. And I think about 85%, because we're trimming off some stuff, like I was saying, that one that went in auction that nearly failed to complete. Obviously, it's a landlord buying that because it's already got a tenant in situ, right? But the vast majority of what we sell off is sold off on the open market because we know we're going to get better price.
Yeah.
Most of that has been sale agreed within 2 weeks or even shorter time periods of being on. And all of that is selling to, I think only one other one did I sell to a landlord. The other sort of dozen or so, they all go into owner occupiers. So
Just a quick question, Adam. 6-9 months ago, a lot of stuff that was going onto the open market was going into best and final offers within a week and stuff like that. Even though your stuff is still selling within like a really short period of time, is it just one person that's coming in and offering price, or is it still going to like best and finals? Like, how hot is that market?
I'll split that into where they are probably, Jay, because Wales is still very, very hot. So Wales, we are tending to get best and finals still.
Okay.
I don't think we've listed anything for about the last 3 weeks because we're kind of a little bit ahead of the game, as you would hope we would be. And we kind of decided what we were doing some months ago and have just been going through the process. It's definitely a little bit cooler in England. And we've just had of this suite of, I can't remember if it's 12 or 15 we're selling like individual units. We've just had our first fall through. Now, we'd hope to be very, very good at avoiding fall throughs because, for example, I had an offer of 100. I don't think many people would do this. I had an offer on a property of 100 grand. I only thought it was worth 85. Let's just be clear about that. And I had a cash, and that was with a mortgage, and I had a cash offer of 92. And I had no doubt in my, and the party wall was with a pub. And okay. I asked the details of who their mortgage was with. Said they've got a decision in principle approved with Godiva, who I don't do any business with because I think they have a limit of 3 buy-to-lets. So it's a little while ago we parted company. I phoned my broker and said, do Godiva do lending on properties that are next party wall with a pub? And he said, no. He said, I had one of those turned down 6 months ago. So I'm pretty sure they won't do, So I took the 92. Most people would have taken the 100 and then it would have fallen through and dropped into the statistics, But our first one, that's up in Barrow, which is a trappy little market all of its own. The geography is really interesting and it makes it quite a difficult area, even for people I know who are up in Barrow. It's not the easiest to get the contractors to come to. A lot of contractors sucked out of the pool by BAE. If you want to get there from Carlisle, it's an hour and a bit, and you'd be rather an hour and a bit in Carlisle. You can be in a lot of places, including Scotland. So you don't necessarily want to be driving around the hook to get to Barrow. So that's actually the driving reason for us selling it off, because it's just too hard to get works done. Too hard.
Yeah.
But you have the certainty over the extra 8 grand, which in the scheme of things.
Absolutely. And I could never see it valuing up at 100. I mean,
right.
I mean, it might have done. In Wales, like I say, Wales is still in the red hot to white hot category, definitely. And you can see that borne out in as Jay was saying about the EIG figures. If you go to regionals on the retail price figures for house price figures, you're still seeing Wales chug along quite nicely. And that I'm scratching my head a little bit about that as well, because I remember when the referendum 2016, Wales market took quite a bath. And I think the prevailing logic at the time was Wales gets a lot of money per capita from the EU, and it's going to suffer. Now, there's obviously an element of truth to that logic, but the reason why I started buying in so heavily was the toll coming off the bridge, and I just thought I don't really believe that this is going to have the dramatic impact that people are expecting. And then we went on an absolute heater. And then since COVID, that's really sort of persisted. Whereas the reality is there's a lot of secondary market stock that's quite poor build quality. You've got much more in terms of water and damp in general to deal with because of the climate. And there's a lot of single skin properties, especially rear extensions and things like that. So I'm quite pleased to be divesting a few. I love Wales, lovely, beautiful country, lovely place to go on holiday. I have no issue with the Welsh. The Welsh occasionally have an issue with me, but we usually get through it one way or another. But yeah, you can't see that. I can't see the justification for those price rises continuing in the way that they are. So if you wanted to look at markets that maybe could take a bit of a fall in 6-9 months' time, and of course, you've got lower income per capita as well, lower household income. So the utility bills piece is disproportionate to the Welsh as well. So I wouldn't be surprised. I'd be surprised if England prices take a big downwards tumble. Caveat being, if energy prices double from here on, I think anything could happen. We could have a really deep recession, which will see rates go back to zero, by the way, and quantitative easing straight back in the mixer. Interestingly enough, so let's see.
Cool. Got Michelle saying hello from sunny Wandsworth.
Hi, Michelle.
And Lara is saying, if you're a commercial landlord, the mortgage rates are going up, but rents are not going up like they are for residential. Do you think it's a problem?
I think that's a really, really good comment. And obviously it is a problem. Now, you guys tell me, I mean, obviously the deal that you were talking about earlier, rents haven't gone up for years and years and years and years and years. So you're just talking about way below market. So what asset classes are we talking about where rents aren't going up? Because we've seen in the nicest possible way, fairly scruffy lower end tenancies in commercial that I was talking about. So hair and beauty, stuff like that, cafes, whatever. We are seeing, I think, 7 to 10% increases when we've been looking at renewals and rent reviews and the likes of that, whereas we haven't increased those for years and years because the market hasn't supported a rent rise. So I don't know that rents aren't rising, but I don't have enough commercial data.
I mean, I think that the rents are kind of increasing for properties that, like you say, haven't been increased for a while, or they're like service-based businesses which are going well. But then there will be things like, for example, banks. Like so many banks used to pay a lot of money for properties. There's a client of ours. She's an auction buyers club, and she's looking at buying this HSBC somewhere in the Midlands, and their lease is coming up to an end, and they were paying 28,000. Now the seller is negotiating new rent, and their proposal came in at 13k, and they're hoping to get this agreed at 16. But that's a massive drop for rental. And if HSBC goes, then to let it to someone else, it would be quite a lot of effort, quite a lot of kind of time. So that's a 35% decrease in rent. Like if it's at the level that you want, but if it's less, then it's like half of the rent that they used to get. So I think banks or like
you're talking about the value of the building going down by a third, really, if that goes through, aren't you? Probably something like that. I mean, it's significant.
That's the thing with commercial property, is that the value of the property it's very rarely bricks and mortar. The value of a commercial property is died into the quality of the tenant, the term of the lease, the amount of the rent, and actually in the current market, the size of the property. There's a lot of attractiveness for smaller commercial units that get the the business rates relief.
Yeah, and I think Dominic's comment as well is like quite relating to what we're talking about. So looming recession, which you agreed on discretionary spend. People prefer to spend £50 on a day out rather than buying a new shirt. Leasing to a nice coffee shop would be more secure than renting to closed shop or office space. Well, last night we went out. It was super cold. We spent money on a night out, and I bought this as well. So I think sometimes things go together quite well.
But in fairness, where this was located, it was in like a food court, right? So it was a hustly bustly food court, and this was kind of like a souvenir shop that was next to it. So it was kind of. I think the reality is you need to be finding businesses. So like Dominic said, you can go online and you can buy a shirt, and if it doesn't fit, you can send it back the next day for free and do any kind of things like that. But if you want to go out and have an atmosphere or have a day out, you need that kind of experiential stuff. And I think there's good value retained there. I mean, a lot of the banks that we're seeing sell at auction at the moment, the HSBC ones, where they're being put onto new 5-year FRIs, and that's it. That's it. Bear in mind, these are banks that were 12, 15-year FRIs for the last 60, 70 years.
Yeah,
So,
yeah.
and the rents aren't bad, but it seems very, and these are selling for like what, 4.68%?
Well, it depends. Some of them are saying like 4 or 5%
Yeah.
in like good areas, or like, but like there's some HSBC on Santander that even struggle to sell at 9, 10%
Yeah.
on new 5-year leases, because everyone knows if they go at the end, the value of the property drops massively. So interesting. So I
I
think
think that's a good shout. I think it's a good shout from Dom. He slipped in the office space bit at the end there, which is obviously a bit different.
Yeah.
But I do think what he says holds some water. I mean, someone was telling me about some office space that's traded at 2.5% yield in the
Wow.
past. And that you go back to the and I believe there's some industrial not that far from Birmingham that apparently is traded at around 3% yields. And that's the sort of stuff that I think, this is why it's not just about cash flow in recessions and building like that margin of safety over and above the interest rate, as we were talking about earlier. That makes a lot of sense. But people sometimes miss with commercial the volatility element of when you're at very compressed yields. And you have much more protection at 12%. 12% goes to 15% on a RICS valuation. Okay, shrug the shoulders, but you're still, even with high interest, even if you're fixed at 7%, which is a horrible rate, right? But even if you're fixed at 7%, you're still okay. Whereas if you're at 4.68 and then base did go above where some of the forecasts have been, and base was 4 and the 5-year bond yield was 4, imagine the value. I mean, you just get murdered. You're absolutely murdered. Your equity's wiped out. You've got margin calls. You've got all sorts of stuff going on.
great comment from Guy. Banks will have to retire ends when they're selling the buildings on the yield.
Funny that, isn't it? It reminds me of a story a friend of mine told me. So he had a quite a nice building in Birmingham, not on Colmore Row, which is absolutely where you would want to be, but a couple of streets back. And he traded out of there, and also they had some subtenants in the building. And he had a letter from a Canadian pension fund, and the pension fund, he said it was a good day when he had that letter because he opened it and it said, here's who we are. We've got a strong view on the next 10 years of growth in Birmingham. We've got a budget of up to X, and X was way more than his building was worth, right? And he said, so he wrote back to them and he said, how strange. I've got a building and actually I would accept X for it. And in order to make the deal work, because he had quite a robust and well-established company, he wrote a lease to himself at the very, very top end of believability for 3 or 5 years so that the valuation would actually go through, and sold it to the pension and sold it for way more. And even so, in those 3 or 5 years, the stock in Birmingham did rise significantly, but it was such a good price. He now rents in leafy Solihull instead, in a very nice office. But yeah, it's funny. It's nice sometimes dealing with these things when they work out, when they'll give you the number up front. It's reasonably good.
Yeah.
There's a really good story that we had from, I think, was it Quasi, about this. Is that HSBC building as well?
Yes.
So it was an HSBC building in Canary Wharf, and I think in 2006 or 5, HSBC sold it to this fund in Qatari or Saudi or Chinese, some fund, the foreign fund, for 1 billion. And they basically, on selling this, they granted themselves a lease for whatever number of years, and they also gave a bridging loan for 5 years to that Chinese fund for like 500 million. And then 2008 or 9 came, and then like the fund couldn't refinance the property, so basically HSBC repossessed it, and then they bought it out for like 500. So basically they bought it out for what they were owed, and then they didn't have to pay the lease payments and the rent payments. And I think they sold it for something like 2 billion some time ago. Like
the circle of life. The circle of life.
They granted themselves a really advantageous lease. They did the bridge on it and the lending on it. They sold it, and then they got it back plus all the interest, all the other bits and pieces. It just goes to show you don't know those deals happen. Probably Crazy tells it far better than we do, but
That's about a similar equivalent to, as I understand it, in Marbella, they've been quite welcoming to certain colourful characters who may or may not be Russian, apart from anything else. And they've got them in. They've spent loads of money building houses, doing various things in business. And then when they've got settled, they just come along and said, illegal activity here. We're taking all your assets away.
Oh, wow.
And it's like, I don't think I'd like the job of going around and breaking it to the aforementioned Russian gentleman, but fairly sharp practice, I believe, has been in use on some of the Golden Mile for some years, as I understand it. Yes, come this way, come this way. Oh no, oh, we've had a change of sheriff, I'm afraid. New sheriff in town, and bad news.
I think coming up, you need to be looking at either underutilized assets, which sounds like a really boring, standard, basic thing to say, but it's valid.
Absolutely.
And then the other thing to look for is flexible assets that offer multiple ways to cut and shut and change and do whatever. Because if you get stuck with a 3-bedroom house and the best thing you can do is a 4-bedroom HMO, there's not many places in the UK where 4-bedroom HMOs are very viable, right? Most people are looking at 6 and above. So you kind of got to think, well, what's my exit? What's my entry? And a lot of people are now just thinking about what's my return, right? They're not focusing on the ins and the outs. It's all about what's the serviceability of the debt.
Yeah.
And they probably don't even think about it like that. They just think about yield.
Well, you raise a really good point, and one of the things I've always detested about the HMO model is people who leave behind 100, 150 grand and have made it into something that is only ever going to be an HMO with en-suites, or it would be another 50 grand to put it back to a family home sort of situation, or it can't even be done because you're just breaking that rule around having exits for, you've got one exit here ultimately. You've got you've got one use of it. Everything else is unviable, and you end up in for 482 grand when the valuation comes back at 450 grand. But if you were going to sell it, you'd only get 380 for it. You just think not a good business model, folks, in my view. But there you go.
Yeah.
Great. Lots of good comments today. Mark as well. On commercial, you have to wait for end review dates to increase rents. And even I've only managed to increase rents in most London areas. Outside London, commercial rates have mainly fallen. Yeah, it sounds like again it's same assets. Like we kind of covered it, I think.
Yeah. We've got a property that we bought that's a high street. It's on a 15-year with no breaks. It was about 6 years in. We only bought the property for the 2 flats above, so we paid a value that was basically the value of the 2 flats above. So the commercial was free. But that's a 9 years remaining, no breaks, no rent reviews in the lease. But if you did have it reviewed, you'd want it to be upward only because they're paying something like, I think they're paying about, no, we're not paying that much. Paying at 775 a month, and the rent today would be 450 for that shop.
Yeah.
But how they got the 775 in the first place, it was only 6 years ago. I was stunned, but
maybe they were selling it off on a yield basis.
And a little bit of it is because it had a 3 at the time, which was worth something, which of course that got destroyed. Just like Article 4 HMOs are worth something. Once the barrier was taken away, bang, just need an empty unit now. There's a lot to be said for Class E. I think really it's under discussed for opportunities, value creation, and value destruction, generally speaking. But there we go.
Perfect. Okay. Well, I've got a few more comments. Okay, Andrew's asking with a rhetorical question: is the recession coming, or just a reset to a new future? Opportunity favors brave, in my eyes.
Yeah, I mean, I think there is a recession coming, but I think the message has to be: is that necessarily a bad thing for people who are going to think through it, who are going to trade through it, who are going to? And I do agree. Opportunity favours the brave. It's the old. I put it in the supplement this week. We seek to be Only be greedy when others are fearful, I think, is actually
Yeah.
how the proper quote works, rather than be greedy.
I think opportunity favors the brave who are reading and implementing Adam's supplement.
I'll go with that.
Next one, Marius, do you have a trusted
Oh.
source of economic reading on future-proofing properties for EPC levels from whole systems seems dysfunctional, in particular retrofitting older Victorian properties?
Now, I think on this, I would say if it's a mid-terrace, right, internal wall insulation, go for it, get it done, get evidence, including photos with tape measures and the whole 9 yards, right? Get it done to a decent standard. So you might have to use 100 mil these days. You lose a bit of space out of the property, but that will get you to a C. And if it's end terrace, semi, or detached, different kettle of fish. But the changes that have been mooted in the June, what's going on at the moment is ridiculous. They've penalised electric even more, which is completely wrong when they want to move away from gas. I mean, they wanted to move away from gas before February, Ukraine and Russia. If you don't want to move away from it a bit more now, then what the hell's going on? But I think there's a big disconnect between SAP and EPC, and they don't. Left hand's not talking to right. They don't know their, I'm afraid, arses from their elbows. So a lot of this is about getting one done. If we buy one in, we're trying to get it to a C, get the certificate. We know we've got 10 years. So it's simple as we. Are there any trusted sources? Not really. One of the guys in our office has retrained to become, well, not to become one, but to have the qualification of being a domestic energy assessor. So we're constantly looking at high heat retention heaters. So if you do anything to do with flats, do a little bit of research on HHR heaters, what it takes to put them in, what positive impact they have. Be really careful, because only certain makes will tick the box in the EPC. But yeah, what Marius says is completely correct. The system is utterly dysfunctional, completely and utterly. And we desperately need a way of monetising solar panels for tenanted properties. There needs to be a Green Deal style equivalent, because unless you are sitting on pots of money and you can afford just to spend it to be nice to your tenants and improve your EPC, you can't have a business case for putting solar panels on roofs. We need a business case for putting solar panels on roofs. So I'm going to stop before I go on a full soapbox rant here.
Change the topic. A lot of interest in life tenancies, clearly no income, all about capital gain on VP. Have you guys ever consider investing in this kind of no cash flow properties where
I would prefer a life tenancy over a reg, over an assured, over any of those protected tenancies. I would go the life tenancy route the whole time.
I think it's not in my investment wheelhouse because it's for parking cash.
Yeah.
I think if you look at it compared to bonds, it's got a vastly superior return. So I see why people do it. It's quite an institutional mindset, but you can't really use gearing, right? And if you can't use gearing, then it makes things very difficult unless you're parking cash. So now, obviously, there is significant amount of cash out there that would love to get into property, and it's a different way of doing it, and if you do it at a scale, you become an insurance company rather than a property company to an extent.
It definitely needs scale, because at scale you can get some. It's the same old thing of if you were a big ground rent investor, if you had 5 or 10% of your portfolio in ground rents, which the historical ground rents I think are still going to, in terms of the value of the historical freehold ground rents, are going to be going up, because we're now at the stage where all new ground rents that are coming in, all new flats that are bought in, have the zero ground rent and all that kind of stuff. So I think they did well in maintaining the value of the past without toxifying the future. But if you were to have 5% historical freehold ground rents and 5% on life tenancies, and you had that cash buffer and you just wanted it parked somewhere, if you're the type of person that doesn't trust a bank, you stick it in property, I think he's right, because you can pick up live tenancies at like 35-40% market value, whereas you can pick up assured and regs around the 65-70% mark. So it's a massive change, and the value of it is really based on the. I'll go off on a bit of a rant here. The value of it is based on the on the tenant. You know, how old is the tenant? Is there a survivorship clause? What
That's
is their
your risk,
health
yeah.
like? Do they live
Yeah.
alone? All that kind of stuff will impact the value, because, you know, the life tenancies are, it's like you say, it's almost an insurance that pays out upon not the sale or the purchase of the property, but on the passing of the tenant. And that's a really very interesting class model. I think
One for the actuaries, isn't it? One for the actuaries, absolutely.
yes, yeah. But I think if you if income wasn't your primary concern, and you're not a fan of structured debt, I think you could hold a couple of those and be fairly happy with yourself.
And I think that's right, isn't it? I think that what Guy is saying there is, or what we might be able to read into what Guy's saying there, is there's still plenty of money out there that's looking to get into property one way or another, and
Yeah.
it doesn't need gearing, and it doesn't need all of that stuff. It's flowing into one of the last bastions of somewhat cash flowing assets, which also has a capital growth uplift, which, as you say correctly, Jay, is only appreciated 6 months to 60 years down the line.
Yeah,
It's a really interesting investment prospect, though, that then you're willing your tenant to die.
Not ideal. Not ideal.
I think if you're a smart buyer, you tend to be looking for, you know, a male tenant in their early 80s with a heart condition, because, you know, that's but you don't will them to die, because you're buying knowing that the chance of them living to 106 is going to be exceptionally rare.
Yeah.
You still give them the quiet enjoyment. They have the house. It is as it should be.
As long as you're not delivering them free cigarettes and cheese or something, I think it's probably okay. But
Yeah, turning off the
Cholesterol-rich
knockdown
food.
alarms and all that stuff.
here's your gin, Dave. Here's your gin. Yeah. I know I gave you one yesterday. I know.
Brilliant, good chat. Guys got a follow-up comments saying historically there have been double-digit returns on life tenancies. Also, there are now gearing options. Possibly.
That's interesting. I know Together will do it, but I don't know of any others. So I'd love to hear more about that.
There was a lender maybe 15 or 20 years ago, because I traded them for a short period of time. I always found them very interesting assets. So, but they would lend you, I think it was like 14%, but it was so the interest rate was 14% rather than they lend you 14% of the value. But the interest rate was 14%, but it was rolled up to term.
Right.
So
I've got the dreaded device overheating message. So I think I might duck out before I'm cut off in my prime at any point, folks.
Yeah, sounds good. All right, Adam.
Thanks, guys.
Cheers.
Cool. This us left, and then finish off the chat.
Cool.
Words of wisdom
or a rant. We haven't had a rant from you for a while.
Yes.
Oh, don't get me started. There's a lot I could rant about this week.
Finish off on a high.
This week has felt like a month for me. It's been very challenging for a number of reasons. I won't start a rant at 11:11. I won't start a rant because we could be here a long time. But yeah.
Okay. Well, we'll start with it next week then.
Yeah, I might have calmed down. I might use less expletives than I would today if you started me off today.
Oh no.
No, it's today's been very diverse chat. Say, and lots of comments from everyone. That's good. Always good to have people's interactions, make the whole chat much more interesting.
Yeah, great questions. Thanks, everyone.
Yeah, and anything else to add?
No, I think that's it.
Yeah. Can we leave everyone to enjoy Sunday now?
Yeah. That's it,
Nice.
everyone. Go back about your lives.
Yes, yeah. The chat is over. We'll be back next week. And so, yeah, thanks for interactions. Bye, guys.
Bye.